All right, if you're watching this right now, stop scrolling for a second and stay with me. Silver just dropped $21 in a matter of hours. We're talking about a straight line move from 120 down to 99. And it didn't happen over weeks. It didn't happen over days. It happened fast. This just happened, and the real trigger isn't what most headlines are going to tell you. The way I see it, this wasn't random panic, and it definitely wasn't physical demand suddenly vanishing overnight. Something mechanical snapped, and I'm going to show you exactly what that looks like in real time so you can recognize it the next time it shows up on your screen. If you're holding silver right now, if you're watching precious metals, if you've been stacking, this breakdown matters for you. Your job here isn't to panic. Your job is to understand what actually moved price and why this pattern keeps repeating across every asset class. Before I explain what caused this, let me teach you something most people don't really internalize until they've lived through it a few times. Markets don't move on stories, they move on positioning. Think of price like a crowded elevator. As long as everyone's calm and spread out evenly, it moves smoothly, floor to floor. But once too many people lean the same direction and one cable slips, it's not about belief anymore, it's about physics. The weight distribution changes. When silver ripped higher into that 120 zone, it wasn't just investors buying coins from their local dealer. It was futures traders taking leveraged long positions. It was momentum funds chasing performance. It was systematic algorithms detecting uptrends and auto buying. All leaning the same way. And when you get that kind of crowding in a market, price becomes fragile, even when the long-term fundamental story still makes complete sense. Here's what that means practically. When everyone's positioned the same direction, there's nobody left on the other side to absorb selling pressure. Liquidity looks deep when nobody's testing it, but the moment someone needs to exit, you find out real fast how thin the order book actually is. So, yeah, silver's got supply concerns. Yeah, industrial demand is growing. Yeah, central banks are buying gold, and that supports the broader precious metals complex. None of that changed yesterday. But none of that matters when positioning becomes the dominant force. If this is making sense so far, drop a comment below and let me know where you're watching from. Because understanding this concept separates people who survive these moves from people who get wrecked by them. Now let me break down the actual sequence here, because this matters for you going forward in every market you'll ever trade or invest in. Silver runs parabolic through late April into early May. Momentum traders pile in because the chart looks beautiful, right? Volatility sellers get comfortable because implied VL had been declining, so they're selling options premium thinking they're collecting easy money. And leverage quietly builds across the futures complex. You don't see this part on a price chart. It's invisible until it matters. Then the US dollar starts catching a bid again over the last week. Yields push higher. The 10-year yield moves from about 4.2 back toward 4.5. That doesn't sound dramatic, right? But here's the thing that most people miss. Those moves change margin math instantly. When you're holding leveraged futures positions, your broker requires you to post margin, which is basically collateral. When volatility increases or when the dollar strengthens and commodities weaken, margin requirements can increase. Your position might not have changed, but suddenly you need more cash in your account to hold it. So when silver fails to hold 120, that's not just a chart level. That's a psychological line and a mechanical line in the sand. Stops trigger. Those stop-loss orders become market sell orders. Those sells push price lower, which triggers more stops sitting below. And now you're not in a normal market anymore. You're in a forced selling cascade. It's not discretionary. It's automatic. Systems are selling because they have to, not because they want to. Here's what's wild about this, and this is the part you need to really understand. Liquidity didn't just fade during this move, it vanished. When too many paper positions try to exit at once through the same narrow door, there aren't enough bids waiting on the other side. Market makers step back. They're not going to catch a falling knife when they can see the order flow is one-directional. So price gaps lower, not because everyone suddenly hates silver or because the fundamentals reversed, but because everyone needs out at the same time, and there's nobody willing to take the other side at current prices. They'll take the other side 50 cents lower, then $1 lower, then $3 lower. That's how you get a $21 dump in hours. But here's the part that should make you really nervous if you don't understand it yet. Margin calls start hitting accounts when positions move against you. This is happening in real time during the dump. Positions get liquidated automatically by brokers. You might still believe in silver long-term, doesn't matter. Your broker closes your position to protect themselves, and momentum flips from buy the dip to get me out at any price. This kind of move feeds on itself. It accelerates specifically because it's not discretionary anymore. It's structural. The market's plumbing is forcing sales, regardless of what anyone thinks or believes. Now let me add the secondary layer here, because it's not just futures traders getting squeezed. The options market plays a role too. When silver's rallying, dealers sell call options to speculators who want leveraged upside exposure. To hedge those short call positions, dealers buy futures. That buying pushes price higher, which makes more calls go in the money, which requires more hedging, which means more buying. It's a feedback loop on the way up. But when price breaks and starts falling fast, that whole process reverses. Calls go out of the money. Dealers unwind their hedges by selling futures. That selling accelerates the move down. You get what's called a negative gamma environment, where dealer hedging amplifies moves in both directions. And here's where it all converges into what we saw yesterday. You've got leveraged longs getting stopped out. You've got margin calls forcing automatic liquidations. You've got options dealers unwinding hedges and selling into weakness. You've got systematic trend following funds that were long flipping to flat or even short. And you've got a dollar rally and rising yields providing the fundamental backdrop that gives everyone an excuse to sell. All of these forces hit at once. That's not a normal correction. That's a positioning unwind. That's excess leverage being purged from the system in the most violent way possible. Zoom out for a second, because this isn't new, and it's definitely not unique to silver. This is the exact same playbook we've seen over and over across different assets. Think back to the silver spike and crash in 2011. Silver ran from under $30 to nearly $50 in a matter of weeks. Then exchanges hiked margin requirements. Suddenly holding those positions became more expensive. What happened next? Silver crashed from 50 back to 35 in a week. Same pattern: crowded trade, leverage builds, trigger event, cascade, reset. Or look at oil in 2020. This one's even more extreme. Oil futures went negative. Negative $40 a barrel. How does that happen? Positioning stress. Everyone was long crude through futures and ETFs, but storage was filling up and the front month contract was about to expire. Physical delivery was becoming a real problem. Holders couldn't roll their positions because the market structure broke, so they sold at any price. The fundamental story about oil demand didn't matter in that moment. The mechanics took over. Same pattern. Even Bitcoin's done this repeatedly. December 2017, Bitcoin hits nearly 20,000. Leverage is sky high on exchanges. Then it drops 70% over the next year. March 2020, COVID hits, and Bitcoin drops 50% in 2 days as leverage positions get liquidated across all risk assets. May 2021, Bitcoin's at 64,000. Futures open interest is at record highs. Then it cuts in half. Every single time this happens, people argue about narratives afterward. They blame whales or manipulation or Elon Musk tweets or whatever. But the pattern stays the same. Crowded trade, leverage, trigger, cascade, reset. When you zoom out and look at these events over years, the larger story isn't about fundamentals failing. It's about excess being purged so the market can rebuild on a healthier foundation. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be manipulation? Could big players be smashing paper markets specifically to scare retail holders out of physical silver? Let me be completely honest with you. Those arguments show up after every fast move in precious metals, and sometimes there's probably truth in them. The paper market is enormous compared to physical. A few large players could theoretically move prices. Banks have been fined for spoofing in metals markets before, so yeah, maybe. But here's the thing. Focusing on that doesn't help you. You can't control motives. You can't prove manipulation in real time when you need to make decisions. What you can control is recognizing when price behavior screams positioning stress. When moves are fast, vertical, occur with thinning liquidity, and happen across futures and options simultaneously, that's not emotion, that's mechanics. That's what you need to focus on. Whether someone intended to trigger it or whether it was organic doesn't change how you respond. The pattern is what matters. The structure is what you can read and react to. There are probably 3 types of people watching this right now. First, there's you if you were long silver, maybe through futures, maybe through miners, maybe through SLV, and you're feeling absolutely punched in the gut right now. If that's you, breathe for a second. This move doesn't automatically invalidate the long-term thesis about monetary metals or industrial demand or supply deficits, but it does mean that leverage matters more than conviction. If you were over-leveraged, this is an expensive lesson about position sizing. If you were in physical, you're probably fine long-term, but mentally shaken. The key thing here is don't make emotional decisions right now. Don't revenge trade. Don't double down trying to make back losses immediately. Let the volatility settle. Second, there's you if you missed the rally up to 120, and you're feeling a little relieved right now, maybe even a little smug. For you, the lesson is patience pays off, but don't confuse luck with skill. Violent resets like this often create cleaner opportunities to enter, but only after volatility compresses again and positioning resets. If you're thinking about buying this dip, make sure you're doing it with a plan, not just because it looks cheap compared to where it was yesterday. Wait for consolidation. Wait for signs that selling pressure is exhausted. You've got time. And third, there's you, if you're just trying to learn how markets actually work beyond the headlines. If that's you, this is gold. No pun intended. You just watched a textbook positioning unwind happen in real time in a major market. This is the kind of education you can't get from a textbook because it involves emotion, speed, and chaos. Study this. Screenshot the charts. Remember how it felt to watch, because you'll see this pattern again in crypto, in tech stocks, in bonds, in commodities. No matter which of these three categories you're in, the universal rule is this. When everyone's on the same side of the boat, watch the waterline. When positioning gets crowded, fragility increases, even if the story still sounds good. So here's where I stand personally. And I'm not a financial advisor. This is not financial advice, but I'll tell you what I'm doing. I'm not panicking, and I'm not blindly buying the dip either. I'm watching. Let me tell you what I'm personally watching over the next few days and weeks. First, I'm watching how silver behaves around the $100 area. Does selling pressure slow down here, or does it stay heavy and push through to the mid-90s? If it consolidates and starts building a base, that's a sign that forced selling is exhausted. If it just chops around violently, we're probably still in the unwind phase. Second, I'm watching the dollar and yields, because if those keep pressing higher, the pressure stays on commodities broadly. Silver doesn't trade in a vacuum. If the 10-year yield pushes toward 4.7 or 5%, if the dollar index breaks above 106 and runs, that's a headwind. Doesn't mean silver can't go up, but it makes it harder. Third, I'm monitoring volatility itself. When implied volatility stops expanding and starts to compress, that's when the mechanics calm down. You can track this through options data or just by watching how price moves. When the $5 and $10 swings in a day turn into $2 ranges, that's your signal that the storm is passing. Based on everything I'm seeing, this dump event was mechanical and structural, not fundamental. The fundamental picture for silver, the supply constraints, the industrial demand from solar and EVs, the monetary role as an inflation hedge, none of that disappeared in an afternoon. What disappeared was excess leverage and crowded positioning. If history rhymes, and it usually does, this was a reset, not an obituary. We've seen this in 2011, we saw it in 2020, we've seen it in multiple assets. The ones that have real fundamental support come back. The ones that were pure speculation don't. I'm not saying silver's definitely going back to 120 next month. I don't know that. Nobody does. What I'm saying is the process matters more than the prediction. Watch the signals. Watch positioning data if you have access to it. Watch how price responds to tests of support. Make decisions based on structure, not emotion. If you made it this far, you're clearly someone who wants to understand how markets actually work, not just get spoon-fed predictions. That mentality will serve you well. The people who survive long-term in markets aren't the ones with the hottest tips. They're the ones who understand structure, positioning, and risk management. If this breakdown helped you see the mechanics behind the headlines, do me a favor and share this with someone else who needs to see it. Hit subscribe if you want more of this kind of analysis when major moves happen. And drop a comment telling me what you're watching next, because I read those and it helps me know what to cover. Do your own research. Verify everything. Don't take my word or anyone else's as gospel. Stay sharp out there. Think critically, watch the mechanics, and make your own decisions.